Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill. Joining me in studio this week from Motley Fool Income Investor James Early, and from $1 Million Portfolio, Charlie Travers and Ron Gross. Gentlemen, good to see you as always.
Hey,
good to see you, Chris.
We got a lot going on. We've got home improvement stocks on the rise. We got a couple of tech giants making headlines for very different reasons, and a little bit of trouble in the Magic Kingdom. Summer movie season officially kicks off this weekend, so we've got Nell Minow as our guide, and as always, we've got a few stocks on our radar. But we begin this week with the Fed chief. On Wednesday, Ben Bernanke went to Congress to testify before the Joint Economic Committee and said the U.S. job market is still weak and it is too soon for the Fed to end the stimulus program. Ron, I should say we're taping a little earlier this week because of Memorial Day weekend. So if the market goes crazy late in the week, everything we're about to
Disclaimer.
say it may be moot. But what we saw on Wednesday when he made those comments, in the wake of Bernanke's comments, the market was on the rise, but then later in the day we had the minutes from the latest Fed meeting come out where it seems like behind closed doors we got some members of the Federal Reserve saying as early as June we need to scale back this bond buying program. First and foremost, what did you make of Bernanke's comments?
I think it's time to buckle up because we're going to be ready going through this seesaw ride week in and week out for the next several months with every little hint that something may be occurring. I think in the end what's going to happen is going to be measured, gradual, it's going to be reasonable, and hopefully it's going to work out just perfectly. I said hopefully. The Fed has taken in $3 trillion worth of mortgage and treasury securities since the latest QE quantitative easing program has been in place. So they're not going to just yank that away. They're going to come down gradually as they see unemployment come down. They've said 6.5% is kind of the magic number. We're still at 7.5% in terms of unemployment. So as things get better, they will very rightly so ease up on these programs, but it's going to be kind of gradual.
But Bernanke himself, though, seems more conservative, Rod. Wouldn't you? I mean, weren't his words like, I want to avert premature withdrawal from stimulating, something like that. I mean,
he definitely, funny, as we were saying before the show, he is a student of the Depression. I think he's a relatively conservative guy. He doesn't want to do anything. He doesn't want to yank off the Band-Aid too quickly. And then there are some who think it's time. They're probably more worried about inflation. I don't see any reason to be worried about that at the moment, but they are probably worried about that down the road, and they want to pull things back maybe beginning as early as next month, but I don't think that's going to happen.
Charlie, it does seem, to Ron's point, it does seem like there are some people out there who almost overreact to any hint of this as though all of a sudden the plug is going to be pulled all of a sudden, and there's not going to be sort of this gradual drawdown.
And they're completely wrong. I mean, the Fed knows very well the impact its words have on the market and its policies. It will telegraph anything it does very carefully. There's no reason to panic.
Ron, last question on this topic. 6.5% unemployment. Is that realistic? That seems wonderful if we could get there, but that also seems so far off in the distance. I have a hard time believing that we're going to get there.
I kind of agree with you. It's a big number. 1%.
I'm sorry, that must be hard for you to agree with me.
1% is a big number, and obviously until corporations start hiring in meaningful ways, we won't come anywhere near that. But if GDP picks up and we see the need to increase production, increase capacity, increase sales staffs, if everything just starts to work perfectly, if you will, then we'll get to the 6.5, which is still not that low a number, by the way. It's still relatively high, but it probably means the economy is chugging along nicely.
But it's all like a traffic jam at the end, right? Everybody just needs to step on the gas and go 5 miles an hour faster.
Right. If we just say if that first guy in the traffic jam would just
agree
go.
to do it at the same time. That's the hard part.
This week, Microsoft unveiled the Xbox One, the next generation of its gaming system. And Charlie, you know more about this than I do. This seems like it's a whole lot more than a gaming system all of a sudden.
It is, Chris. I have one item on my Christmas list this year, and it is the Xbox One. It's a continuation of the strategy they're pursuing with the Xbox 360, which has been their gaming console since 2005. When it started out, it just played games, but it morphed into a device that lets you stream content from Netflix, Hulu, Amazon Prime. And so the Xbox One announcement even takes it a step farther. It allows you to do voice search of your cable channels. For example, you could say, watch AMC, watch HBO, and it'll just automatically flip to that channel without you having to fumble around with a remote. They've signed a big partnership with the NFL, which is truly exciting. They really pulled an end run, so to speak, around Apple and Samsung there to get their technology to be the tablet and the console of the NFL. So it's a very exciting announcement, and I think that bodes well for them heading into the holiday season this year.
What do you think this means for the stock? And I should point out that shares of Microsoft up about 30% year to date, and most of that gain, I'm happy to say, he said tongue-in-cheek, came after I sold it. So basically...
we told you not to, just for the record.
You're welcome, Microsoft shareholders. Apparently that's what they were waiting for. They were waiting for me to sell it. But what does this do for the stock long term?
So I think there's going to be a huge bump in revenue as those system sales start coming through at the end of the year. Longer term, the transactional revenue from processing people buying movies through the console is a big long-run winner for them.
This week in home improvement stocks, Home Depot's first quarter earnings came in higher than expected. Same-store sales up more than 4%. Lowe's first quarter earnings rose just 2.5%, and same-store sales fell slightly. And James, both stocks hit all-time highs. What do you make of this industry?
Chris, the backstory: there's been a sort of a frisky little love spat between these two companies for the past forever, really. The past 5 years, Home Depot has more than doubled Lowe's stock price performance, is largely because they realized that customers wanted to be treated like actual people. They got serious about their customer service. They stopped carrying, locally irrelevant items like snowblowers in Florida or whatever, and it's worked. So again, here we have incremental differences. Lowe's had a comp store sales up 0.7%. Home Depot was 4%. Stock price for Home Depot went up a couple percent after this earnings. Lowe's was kind of flat overall over the past couple of days. So it's not like a huge thing, but it's doing like a little bit better every quarter can make a massive difference over time, and that's what happened with Home Depot.
Is part of when I look at Lowe's latest quarter, the results don't seem to justify the stock hitting an all-time high. Is part of that just sort of this rising tide we've seen over the last few months in the market in general?
I think you have to. I mean, it's great to look at the all-time high and say, okay, that's the glass half full, but I think you got to look at the glass half empty and how far it's lagged Home Depot. I mean, it could be doing a lot better.
Hewlett-Packard's second quarter profit fell 32%, but apparently Wall Street was expecting worse because the stock was up more than 14% Thursday morning after the results came in. CEO Meg Whitman says you can feel the turnaround taking place at HP. Charlie, can you feel it?
This stock is like the crash test dummy bouncing off the inside of the windshield, Chris. I had to channel my inner James Early there. So you got to remember, the stock has done well. Today it was up 13%, but over the last 3 years, while the market overall has done well, it's down 50%. You see things like their personal systems revenue, which is computers you buy in the home, down 20%. They're trying to turn that around with Android tablets like their Slate 7, which at $169 is actually a pretty good value. They're doing well in printers. They're cleaning up the balance sheet. Overall, I actually think the company's doing well. I mean, surprisingly well. I thought this company was on the brink of disaster, given some of the PC numbers we were hearing earlier this year. But they generate a lot of cash, and they're doing a lot of the right things.
And part of this, though, is that they're getting smaller, which if you're looking to get profitable, that can work in the short term, but that can't be sustained over the long term, can it?
I think a smaller, higher return on capital business is actually a smart strategy for HP. And if you look at their numbers, they generated $10 billion of free cash flow last year. And for a company that I think the market has written off for dead, that's a lot of cash against a $41 billion market cap. It actually looks kind of enticing here.
Really? So
yeah, I'm shocked to say that because I thought they were
the crash test dummy stock is
yeah,
looking good.
But actually he's a good driver.
Coming up, evidence this week that Disney's cash cow is not, in fact, bulletproof. Details next. This is Motley Fool Money. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. Welcome back to Motley Fool Money. Chris Hill here in studio with James Early, Charlie Travers, and Ron Gross. As we have said in the past, guys, when you look at the Disney empire, ESPN is the cash cow. But reports this week that ESPN is laying off between 300 and 400 employees. And Ron, that's upwards of 6% of their staff. First and foremost, were you surprised by the news?
I was, but I probably shouldn't have been, because if you think about the competitions that's been coming on board in the sports space from NBC, CBS, Fox, And then you can see the broadcasting rights, the cost of those have been skyrocketing, whether it's Major League Baseball up 100% since the last renewal, or U.S. Open Tennis up 400% since the last renewal. These costs are just really, really exponentially increasing. So if ESPN wants to maintain the same level of profitability, it needs to do something to its cost structure, and laying off people is certainly one lever they can pull.
That seems a little backwards in a sense. I hear what you're saying. It's almost like be rational with your cost structure so you could be irrational on your bidding for what you're paying to get the rights for these sports.
Right, but I mean, what is the alternative? I mean,
Right.
they need to maintain, their top, at least stay in the game for sure. Like if they were to lose NASCAR or something like that, it would be a pretty big deal. So they need to put up these numbers. They need to put in these competitive bids, and they could accept a lower level of profitability. They're choosing not to.
As long as it doesn't affect our dressage coverage, Ron and I don't care, right?
I don't even know what that is.
You
Campbell Soup's third quarter profits came in higher than expected, and the company raised guidance for the full year, which sounds pretty good to me, James, and yet shares were down this week. Why?
Well, I mean, there's good and bad. First of all, the positive, Chris, is that Soup was basically, we didn't know if it was cool. For years, sales had been going down, and we finally had a little bit of a bump. Most of the bump was actually from an acquisition of this Boathouse juice brand. You go into the supermarket, they have these kind of gourmet juice drinks, and you come to find out they're all loaded with sugar. I would never drink them, but they're very popular. But margins are still suffering, and the gross margins are the real problem at Campbell's. So until that turns around, I think the stock price is going to stay low.
One of the things the company said when they issued the results was that they're disappointed in the performance of their U.S. beverage unit, and the bulk of that is V8, which is a juice that I don't drink mainly because it's really, really healthy, or it's supposed to be really healthy. And we've talked before about the health trends in the U.S. and soda consumption on the decline. Why is V8 not just crushing it for Campbell Soup?
That's a great question, Chris. You think of it doing well, but there's a lot of competition in the juice, the shelf-stable juice segment, it's called. V8, it's okay. It's a little bit old. It's very acidic. It's like one step below Drano in my book. It practically burns a hole in your stomach. So people are going to other options. There's just a lot of competition out there.
Do they need to partner up with like a Diageo, someone who owns some premium vodka, and just go hardcore after the Bloody Mary
That's
market?
an idea.
Nice.
That's an idea.
Actually, V8 does not make a good Bloody Mary. You
Really?
need straight tomato juice.
Okay.
I've tried it.
Okay.
Just saying.
See, we go the extra mile here at Motley Fool Money. We do on-the-ground and in-the-liver research. What we touched on last week is now official. Yahoo bought Tumblr, the popular blogging platform, for $1.1 billion. And Ron, I love Marissa Mayer's, one of her first comments when the deal was announced was, she said, "We promise not to screw this up." And that seemed to be aimed not at Wall Street, not at shareholders. That seemed to be aimed at the more than 100 million people who have blogs and really enjoy the Tumblr platform.
And don't want it changed, right? And the Tumblr employees, the company itself didn't want change to come. I do appreciate Marissa Mayer's, her sentiments there. I don't know how you can promise something like that, because clearly Yahoo has screwed up many, many acquisitions before her time, of course. But we have lists of them. As I said last week, I think it makes sense to go after that target market, that demo of the younger crowd to make Yahoo a little bit more hip. The $1.1 billion is a big number for me, especially as a percent of their cash on hand, which is in the $3 billion range. So I think they perhaps overpaid for a company that really hasn't proven how it's going to monetize all those eyeballs.
What are you talking about? Last year they made $13 million.
Woohoo! That's worth $1 billion.
Sure.
Yeah, so we'll have to wait and see how it unfolds. I always feel like an old man when I talk about these stocks because I'm like, too much money, those young kids. But to me, it's not that exciting.
Before we get to the stocks on our radar, I should mention we have a special free report that you can get just by emailing us. Just email topstock2013@fool.com. That's topstock2013@fool.com, and we will send the report right back your way. This is from Andy Cross, our Chief Investment Officer here at The Motley Fool. I actually read the report this week. It was a company I'd never heard of before and have since added to my watch list. So check it out. Just email us, topstock2013@fool.com. Fool13 at Fool.com. Let's get to the stocks that are on our radar. Our man Steve Roydo is not behind the glass this week.
No, he's not.
We might have to send out a missing persons report or a search party or something. But Ron Gross, you're up first. What's your stock?
I'm going to keep an eye on Costco, which we haven't talked about recently, but many, many times in the past. Probably one of my favorite companies in the world. The stock has done really well. It's at its all-time high. They report next week. I would love to have the opportunity to be able to recommend this stock again. I haven't for quite some time. It's been on hold for us, and we've done quite well on it. But I want to see how the profitability looks, if there's any kind of update in terms of the number of stores they think they can open, whether it's here or abroad. So I'm really interested to hear that report.
We've talked in the past about how difficult CEO transitions can be, and we are more than a year now into Craig Jelinek being the CEO after filling the very large shoes left by Jim Sinegal. How do you think he's doing?
I think he's doing really well, and I think it's actually a credit to Sinegal because he put this corporate culture in place. And he's surrounded him with people that really and truly buy into this culture. It's not, a kind of place where people are going through the motions. It's a very wonderful company that treats its shareholders, its customers, its employees very well. And I think the transition has been very, very smooth.
And you're a Costco customer yourself.
I am correct? A Costco member, yes.
You do the shopping, does your wife?
Personal shareholder and a professional shareholder as well.
Nice.
James, what's your stock this week?
Chris, I have recently looked at Apple in my Income Investor newsletter. This is a company that I never thought I would consider, but they're paying a decent dividend, and essentially for all the reasons that the kind of the tech fanboys don't like it, I do like it. Tim Cook is kind of a boring guy. He's not a great presenter in the way that Steve Jobs was. He's not flamboyant, but he's been very mature about understanding Apple's strategic and capital budgeting position, implementing a dividend or jacking up the dividend too. It's been very responsible, so it's great for me as a dividend investor. I have worries about the stock just based on risk, but I think long-term they got plenty of cash. I think it's undervalued right now.
For a long time, Apple was number one on a lot of people's list for this company should be paying a dividend. Now that they are, what's number one on your list of a company that you look to and say, it's time? It could be a wish list if you want.
I can't answer that question. I don't know who's that.
What about like
rich.
Berkshire Hathaway?
Well, that capital is in the hands of the world's best capital allocator, so they shouldn't be paying a dividend. But that's because he's Warren Buffett. Most companies should, because most companies don't have Warren Buffett managing that money.
Charlie, we got about a minute left. What do you got?
I'm keeping a very close eye on Yum Brands they're the owner of KFC and Taco Bell because of all of their problems they're having in China with absolutely abysmal KFC performance over there. This is a big deal for Yum because China is half of the company's operating profits. The stock has not reflected the problems. They are believing, the market believes management that this is a temporary issue. The sales are quickly going to rebound. I'm not so sure about that. And if they don't, I think the stock's going to come down into a point where it'd be a great buy. We find out on June 11th what the May sales numbers are going to look like. In April, they did a minus 36% same-store sales for KFC in China. A couple more months of that, and this stock could look quite tempting.
All right. Charlie Travers, James Early, Ron Gross. Guys, thanks for being here.
Thank you, Chris.